The danger to the volatility is that you throw participants offside and into margin calls. And if you do that on a grand enough scale, if it's big enough and far-reaching enough, you're going to hit somebody who's big that can't pay. And that will start off a daisy chain of derivative failures. There's over $2 quadrillion worth of derivatives outstanding, completely dwarfs the financial system, completely dwarfs all treasuries and all sovereign central banks on the planet. So the danger is that you get a derivatives player that becomes insolvent, and then it will spread like a wildfire from...
You're watching Silver News Daily. Subscribe for more.
Everything you thought you knew about silver is about to be shattered. Right now, Comex vaults, the very backbone of global silver trading, are hemorrhaging physical metal at a terrifying rate. Registered inventories are vanishing, shipments are drying up, and yet the paper market keeps trading like nothing's wrong. But what happens when the music stops and there's no chair left to sit on? What happens when traders go to take delivery and there's nothing there? At the same time, the world is sitting on a derivatives bomb so massive it's hard to comprehend. Over $2 quadrillion in notional value, most of it unregulated, most of it off-balance sheet, and much of it tangled in leverage connected to silver and gold markets. It's a fuse that's already been lit. Banks are bracing, governments are cornered, and the margin calls haven't even started. Bill Holter isn't just sounding the alarm, he's showing us the cracks before the collapse. A $500 silver price isn't some fantasy. It's the logical reaction to a system that's finally out of road. Because when the vaults are empty and the panic sets in, silver isn't just going to move. It's going to explode. Ready to see how we got here? Let's go deeper.
Because of the ratio, and now we're close to 100 to 1, takes almost 100 ounces of silver to buy 1 ounce of gold. You want to concentrate on gold. I'm sorry, you want to concentrate on silver. You want 70% or more. If you're just starting out, you want 70% or more in silver versus gold. And then at a later date, as silver outperforms and the ratio comes down, then you look to start swapping silver into gold, and you'll end up with more gold ounces. When the ratio comes down to 50, 40, 30, as silver outperforms, you're buying cheaper gold with more expensive silver. So you end up with more ounces. As for the U.S. Mint lineage, the reasoning behind that is, for instance, I mean, if you buy a gold eagle today or you buy a silver eagle today, the mint is basically selling it to you through a broker conduit. It'd be really difficult for them to sell eagles to you today and then next week and say, oh, by the way, we're confiscating it. You have to sell it back. Now, could they do that with Maple Leafs or Krugerrands or bars or whatever? Yeah, they could do anything they want. And they could do something with U.S. Mint lineage coin, but there will be lawsuits and there will be lag time where there would not be with foreign sovereigns or bars or generics. With silver, I believe it's hands down that you want to own junk silver. It's the smallest form, 14 dimes, roughly 14 dimes equals 1 ounce. So that's going to give you 14 barter transactions in a system down scenario versus one, whether it be a bar or a round or a foreign sovereign or even an eagle. So you want the smallest denomination. They are U.S. Mint lineage. They're readily recognizable. They really can't be counterfeited because junk can't be shiny. Junk needs to look like crap. It needs to look like it's been used because it was used. And when I said readily recognizable, as long as the coin says on it 1964 or earlier, you know it's a 90% silver content. So for silver, I think hands down, you want to do junk. Switching to gold, again, you want U.S. Mint lineage coin. It's much more likely that gold would be confiscated than silver. And just to mention on potential confiscation, it's my opinion they won't go after individual holdings. It's far more likely, in my opinion, that they would nationalize mining operations. They'd get more gold faster doing that, and going door to door, there's going to be deaths on day one. But as far as gold, you want either eagles or buffaloes, or 333 gold, which are the Liberties and St. Gaudens. They're as cheap as I've ever seen them in relation to spot. I mean, you can buy, I don't know, an MS 62, 63 Lib or Saint for basically the same price as an eagle, or maybe even slightly less. So the pre-33 gold, which, you know, a lot of people shunned in past years because they had a 20 or 30% premium over spot.
Comex.
There virtually is no premium over spot.
Exchange,
Now's the time to buy those.
where the story isn't just low inventories, it's evaporation. Over the last year, registered silver in Comex vaults has collapsed by more than 70%. This isn't a gradual decline. This is a bleed out. And what's worse, the decline isn't being replenished. Bullion banks and institutions are withdrawing metal and not redepositing it. Silver's leaving the building, and it's not coming back. But here's what makes it even more dangerous. The silver that's supposedly available for delivery may not actually be deliverable. Much of it is spoken for, leased, hypothecated, or otherwise encumbered. So when we see a number like 30 million ounces left in the registered category, the reality could be a fraction of that. It's a confidence game, and confidence is cracking. And yet, Comex still trades like a river of silver flows beneath it. Contracts are flying. Millions of ounces bought and sold on paper every day. But very few of those trades ever result in actual delivery. It's all paper. The ratio of paper silver to real silver is estimated to be over 200 to 1. That means for every actual ounce sitting in a vault, there are over 200 claims to it. What happens when even 10% of those holders ask for delivery? This is where the spiral begins. The more metal leaves the vaults, the higher the risk that Comex breaks. If the world's largest exchange can't meet physical delivery, then the trust that holds up the entire system could collapse overnight. And if Comex breaks, it won't just be a silver story, it'll be a systemic shock that ripples across every corner of the global financial market. And it's not just Comex. What's coming next is far more explosive, and it's already wired into a global derivatives bomb that's primed to detonate.
I think you could go back to October, November of 22 when Russia's reserves were sequestered. From that day forward, you've seen hedge funds, you've seen foreign central banks, you've seen foreign treasuries, foreign sovereign hedge funds. They've been unloading gold day after day after day, and that's why if you look at a chart, it looks like a tractor in first gear. No big drops, no big spikes upward, but just bottom left, top right. So I think that's been a big hedge because understand that gold or silver, or gold nor silver, are issued by a government. If a country holds gold and they hold it in their own vault, there's no way that can be stolen from them. There's no way that can be sequestered like the 300 billion in Russian treasuries were sequestered. The world looked at that and they said, hey, if they can do it to Russia, they can do it to us. And the decision was made to buy less treasuries and buy more gold.
The global derivatives market is a financial monster, towering over the real economy with a notional value north of $2 quadrillion. It's so large, so complex, and so interconnected that even central banks don't fully grasp the risk. At its core, it's all about leverage. Contracts built on contracts, often with no underlying asset to back them. And when it comes to silver, this web of synthetic exposure becomes a weapon of mass distortion. Most silver exposure on paper markets is not backed by physical metal. It's leveraged, it's hedged, and it's cross-collateralized with other assets like treasury bonds, interest rate swaps, and even commercial real estate. When one corner of this system falters, The contagion spreads like wildfire, and the cracks are forming fast. Just look at the recent stress in U.S. regional banks, the implosion of European real estate funds, and the historic outflows from bond markets. All signs that collateral is being questioned. And here's the danger no one wants to talk about. If counterparty risk starts spiking, if traders start worrying that the other side of their derivative bet won't pay, then it doesn't matter how many contracts you hold. The illusion of liquidity disappears. Trust evaporates. Margin calls come in waves, and institutions are forced to dump whatever they can sell. But what happens when the only thing left with real value is a scarce commodity that's already leaving the vaults? Silver, unlike most financial assets, cannot be printed. It cannot be bailed out. It is finite, physical, and rapidly disappearing. And as this derivative structure begins to unravel, the squeeze on actual metal intensifies. Silver becomes the safe harbor, not just for investors, but for institutions looking to shore up collapsing portfolios. That moment when synthetic exposure meets real-world scarcity, that's when silver goes vertical, and we're already seeing the signs. From Comex to Shanghai, physical silver is vanishing, and the reasons why are just as important as the fact itself.
Well, yeah, the volatility, just the last 3 or 4 days, you've seen, NASDAQ's now already in a bear market. How often do you see markets down 10, 12% in 2 days? So the volatility that we've seen in what you're calling the first 100 days has really picked up over the last week. And the danger to the volatility is that you throw participants offside and into margin calls. And if you do that on a grand enough scale, if it's big enough and far-reaching enough, you're going to hit somebody who's big that can't pay. And that will start off a daisy chain of derivative failures. There's over $2 quadrillion worth of derivatives outstanding, completely dwarfs the financial system, completely dwarfs all treasuries and all sovereign central banks on the planet. So the danger is that you get a derivatives player that becomes insolvent, and then it will spread like a wildfire from there. As far as advice, I view the financial system as a complete Ponzi scheme that's going to be taken down where, I just talked about the derivative failures, but also the assets themselves are going to get wiped out in value. It's time to get out of the pool. That's, I guess, the best way to say it is, or get off the railroad tracks. And the best way to do that and hold capital, again, is through gold and silver because they cannot bankrupt. And the system itself is bankrupting.
The exodus of physical silver isn't a mystery. It's a warning. Across the world, vaults are being drained, not just by nervous investors, but by real, growing industrial demand. From the London Bullion Market Association in London to the Shanghai Futures Exchange, stocks of available silver are plummeting. This isn't some seasonal dip. It's structural. The supply side simply cannot keep up with the intensity of drawdowns happening month after month. First, let's talk about industry. Silver isn't just a shiny metal. It's a critical input in thousands of technologies. Solar panels, electric vehicles, medical devices, 5G infrastructure, all depend on silver's unmatched conductivity. Demand from the solar industry alone is exploding, projected to hit a record high this year. But silver isn't like copper or aluminum. It's not mined in bulk as a primary product. Over 70% of global silver comes as a byproduct of mining other metals like zinc, lead, or gold. So when those sectors slow down, as they are now, silver production suffers, even as demand rises. Then there's investor demand, which has quietly turned from passive to aggressive. Bullion dealers report record volumes, with premiums over spot prices surging. Whales are taking delivery, bypassing ETFs and custodians altogether. Even central banks are rumored to be sniffing around silver, not for public accumulation, but for silent hedging. And why wouldn't they be? As fiat currencies wobble and inflation erodes purchasing power, silver offers a tangible escape valve. And here's the kicker. recycling, once seen as a fallback for shortages, has become unreliable. Much of the silver used in modern tech is non-recoverable or economically unviable to reclaim. That means once it's used, it's gone. So we're not just facing a short-term squeeze, we're staring down a structural deficit. Supply is flatlining. Demand is accelerating. Inventories are collapsing. It's a perfect storm. And into this storm steps the reemergence of a force the banks thought they had buried years ago. The short squeeze. Only this time, it's not a Reddit rebellion. It's global, it's informed, and it's building.
Yeah, the great taking is something that a lot of people don't know about. A lot of people can't believe it. And when you tell people about it, a lot of them want to stick their head in the sand and not believe it. But these laws have been put on the books beginning in 2014 all over the world. The ink is dry everywhere. So these are hard and fast laws that are on the books. And the short of it is, anytime you deposit money with a bank or stocks or have stocks or bonds with a broker, those are not your monies. They're not your stocks, not your bonds legally. They're owned by the bank or they're owned by the broker for your benefit. But the way the law reads is if they get into trouble financially, they can take your assets because they're on their balance sheet. They can take your assets and save themselves. And you have no legal recourse back to getting your assets back. So just understand when they do collapse the system, and I mean, the system is going to collapse, whether they pull the plug on purpose or try to keep it up as long as they can. Mathematically, this thing's going to come down. And when it does, you're going to lose your assets. And that's obviously the biggest benefit to owning gold or silver and having it in your hand, or even in a storage facility, because in a storage facility, there's not a computer button that they can push and take your metal. It's actually got to be, physically moved or taken. But gold or silver, they neither of them can bankrupt. And when the system bankrupts and people lose their assets, gold and silver will be the last two men standing. And if they're in your hand, you have wealth.
In early 2021, retail investors lit a fuse on silver with what became known as the silver squeeze. It was short-lived, heavily suppressed, and ultimately fizzled out. But it exposed a dangerous truth: that silver markets are extremely fragile when faced with coordinated physical buying. That moment wasn't the climax. It was the preview. And now, with fundamentals far more explosive, the real squeeze is quietly being prepared in the shadows. Here's why the next squeeze could be a market breaker. The short positions haven't gone away. In fact, banks have doubled down. JP Morgan, HSBC, and others continue to hold massive paper shorts, using derivatives to suppress price action and protect their wider credit portfolios. But with Comex inventories evaporating and trust in the financial system eroding, these positions are turning toxic. The moment a significant player demands delivery instead of cash settlement, the system begins to unravel. This time, it won't be retail leading the charge. It will be funds, institutions, and sovereign actors who see the writing on the wall. They're watching Comex vaults. They're watching the dollar lose value, and they're watching gold explode past $3,000. And silver? It's still trading under $31, even though its fundamentals are arguably stronger than gold's. The psychological shift is underway. Investors are no longer asking if they can profit. They're asking if they can even get the metal. Premiums on physical silver are surging. Bullion banks are warning of delays. And once delivery failures begin, once even a single major exchange cannot meet physical demand, it's game over for price suppression. At that point, shorts aren't just squeezed. They're forced into a panic unwind, driving prices into open-air territory. And unlike the 2021 squeeze, there won't be a circuit breaker. No meme stocks to distract the media. No Reddit scapegoats. Just a global wave of capital chasing a metal that simply isn't there. And when that wave hits, silver doesn't just go up. It reclaims its monetary role, and fear becomes the driver. Because in the storm of economic collapse, silver becomes something far more dangerous to the system, a safe haven. And that's exactly what it's becoming right now.
for Germany. That was back in 2013, 14. I mean, that was 10 years ago. I think they asked for 320 tons. It was a little over 300 tons. And at the time, because they came out and they said, oh, it's going to take several years to do. At the time, I looked up what a 747 cargo jet could carry, and they could carry 95 tons. So that could have been done in 4 shipments. And obviously, now that we've seen, 500 plus tons of gold moved from Europe to the United States, shows that, yes, it can be done. And the excuse that they used back then that, oh, well, it's just too heavy and it's too much money to do in a short period of time. It's going to take us 2 or 3 years, which it did. And then when Germany got their gold, it was not even their gold. The gold that was received had completely different serial numbers on them. So something happened to Germany's gold. And now they're considering again withdrawing more gold. And it wasn't from Comex. It was from the Fed itself. So it was from New York vaults, but it was being held by the Fed, as I understand it. And I think it just makes sense that more and more, the more lies, outright lies that are discovered to be outright lies, is ruining confidence of foreigners. And foreigners are saying, hey, we want our metal back. We want it back. We want to hold it, because if it's in your hand, you have it. If it's held at the Fed, they're probably bullshitting you and your metal's already gone. So I think this is a move to basically take reserves and rehomeland them by foreigners.
Silver is finally waking up to its original identity, not just as an industrial metal, but as real money. For decades, it's played second fiddle to gold, largely ignored by institutions and central banks. But now, with financial systems shaking and geopolitical tensions escalating, silver is being reevaluated, not for its tech utility, but for its historical role as a monetary anchor in times of chaos. Let's start with the fear trade. The safe haven bid is back, and it's aggressive. Gold has already made its move, shattering through $3,000 an ounce, fueled by central bank demand and a crumbling bond market. But here's the thing. Gold rarely runs alone. Silver always lags at first, then explodes higher as the panic deepens. Right now, we're still in the lag phase, but pressure is building. The catalyst? The U.S.-China trade war just turned into a currency and inflationary battle. Tariffs are surging on both sides. Supply chains are being redrawn overnight. And amid the chaos, capital is fleeing equities and real estate for hard assets. The result? A sharp spike in silver prices, pushing it back above $31, even as technical resistance builds. The move isn't over. It's just beginning. At the same time, inflation data out of China and the West is flashing red. Central banks are cornered. Rate cuts risk igniting further inflation, while hikes risk collapsing. Credit markets. This is the exact macro cocktail silver thrives in. Uncertainty, monetary instability, and geopolitical escalation. Unlike copper or nickel, silver has the ability to switch hats. It flows from industrial demand to safe haven store of value in an instant. And that flexibility makes it lethal when markets are panicking. Even retail sentiment is shifting. Investors who once saw silver as a speculative play are now buying it for protection. Sovereign mints are reporting unprecedented backlogs. And as gold claims the spotlight, silver is quietly gathering momentum in its shadow. Waiting for the moment, it flips from ignored to indispensable. And that moment might come sooner than anyone expects, because what's unfolding now isn't just a trend, it's a global margin call. And silver sits at the intersection of risk and refuge.
Right. Just understand that U.S. Treasuries are the foundation to the global financial system. They're the foundation for everything. And it used to be, years and years ago, gold was the foundation. Gold was a strong foundation. The problem with treasuries is that treasuries are issued in dollars. They contractually promise more dollars. And as the money supply gets printed and created, the dollar loses value. I mean, just the illustration, 270 gold to 3,000 gold, that's, the dollar since the year 2000 has lost 90% or more than 90% of its purchasing power. The danger is that foreigners completely shut down and say, we're not buying any more treasuries. Not only that, we're going to sell the treasuries we have. Well, who's the buyer going to be? The buyer could only be the Federal Reserve. So the buyer of existing treasuries and the lender to the treasury for new treasuries in order to deficit spend or cover the deficit, the danger is that what has been outright monetization becomes outright public monetization. In other words, the public and foreigners, that human beings will be able to see that the U.S. Treasury has limits to what they can borrow, and that limit boils down to whatever the Fed can buy and whatever the Fed can lend. And outright monetization, all you have to do is go back through history. Anytime a government monetizes, the currency goes away, the currency evaporates.
The global margin call has begun, and silver is right at the center of it. As credit markets tighten and asset valuations spiral, institutions are being forced to reassess what they actually own, and more importantly, what it's worth. Bonds are cratering, real estate is faltering, and equities are grinding lower under the weight of stagflation. In this environment, collateral becomes king. And silver, once an afterthought, is being reclassified in real time. Let's break this down. Derivatives are backed by collateral, most of it being cash, government bonds, or high-grade credit instruments. But when the value of those assets drops, institutions are hit with margin calls. They either post more collateral or liquidate positions. And this is where silver begins to shine. Unlike fiat-based instruments, silver holds intrinsic value. It doesn't default, it doesn't get downgraded, it just exists. Tangible, tradable, and increasingly scarce. Now here's the kicker. As these margin calls cascade across the financial system, silver isn't being sold, it's being bought. Institutions that once used it to hedge small positions are now leaning on it as a cornerstone of liquidity. Funds are rebalancing. Sovereigns are diversifying. Even pension funds, once restricted to traditional portfolios, are exploring precious metals as insurance against systemic breakdown. And while this shift unfolds, price discovery is starting to break. Comex futures are diverging from spot, physical dealers can't keep up with demand, and the premiums over paper prices are exploding. Clear signals that trust in the traditional pricing mechanisms is evaporating. The market is splitting in two: the synthetic world of promises and the physical world of reality. This divergence is crucial because when the financial system hits its breaking point, when trust in paper burns away, only what's real will matter. That's when silver breaks out of its cage and begins trading on scarcity, not speculation. And if you think $50 is the ceiling, think again. What comes next could make every past silver rally look like a warm-up. Because the forces behind this are no longer emotional, they're structural. And that structure is now aiming toward one target: $500 silver.
A better date to use is the year 2000. Gold was $270 an ounce. Now it's $3,000. So that's over a 10-bagger with no risk. And when I say no risk, gold can't go bankrupt. There's not too many assets that have been a 10-bagger since the year 2000. When I say open your eyes, what's happened just over the last, 6 or 8 weeks? Just all the revelations coming from Doge of all the bullshit programs where money's gone. Money has gone, and when I say money, this is tax money, has gone into things that the public absolutely does not want and acts against the public itself by charter. Just the revelations of how crooked everything is. And, this is something that you and I have talked about, many in the alt media have talked about for years. how corrupt everything is, and we get trolled and poo-pooed, and you're just making stuff up as you go. Well, guess what? Just in the last 6 or 8 weeks, there's so many things out there that we knew were bad, but it turns out what was actually happening was worse than what we thought. So, that's just one thing. But if you look at what Doge has revealed, foreigners got to be looking at the United States and say, hey, wait a minute. I put my money there because I thought they were a safe haven and had a good rule of law, but they're all crooks.
The idea of $500 silver used to sound outrageous until now, because when you add it all up, the collapsing Comex inventories, the unwinding of a $2 quadrillion derivatives bomb, the global vault drain, the surging industrial use, the return of silver as a safe haven, and the financial system's margin call, it becomes clear. This isn't just some pie-in-the-sky prediction. It's the inevitable outcome of a monetary order coming undone. Let's be blunt. Silver doesn't need hype anymore. The numbers speak for themselves. Supply deficits are stacking year after year. Physical premiums are hitting levels not seen since the Hunt brothers tried to corner the market in the 1980s. ETF outflows show that smart money is moving out of paper and into private vaults. Retail demand is breaking records. Even gold's breakout is dragging silver along, just like it always has. Except this time, silver's still massively undervalued in comparison. So what does $500 silver look like? It looks like the death of confidence in fiat. It looks like vaults being emptied faster than they can be restocked. It looks like a total breakdown in the illusion that paper and metal are interchangeable. At $500, we're not talking about profits. We're talking about preservation. Preservation of wealth, preservation of purchasing power, and preservation of sovereignty in a world where currencies are being sacrificed to bail out everything else. And the wild part? We haven't even seen the panic phase yet. When the public wakes up, when institutions scramble to reposition, silver won't climb slowly. It'll gap up overnight, shattering resistance and rewriting price charts. We're not just on the edge of a breakout. We're at the edge of a reset. So when people ask, can silver really hit $500? They're asking the wrong question. The real question is, what happens if it doesn't? Because at this point, $500 might not be the peak. It might be the floor of a new monetary reality. Up next, why this isn't just a theory, but a calculated conclusion, and what every investor needs to understand before it's too late.
I think it will persist, and I think you answered the question by saying, a lot of metal has been coming out of Comex for delivery. I never believed that the flow of metal to the U.S. had to do with trying to beat the tariffs. And I think that's been proven because, and I haven't looked I didn't see yesterday's numbers, but I know last Wednesday and Thursday there was another 5 or 6 million of silver onshored, and that was after the tariff date. So, there's no way they would ship it. They would ship it late so that it got here after the tariff. So it tells me that the metal basically has been coming here to be delivered. And I think any additional metal over and above that is just reshoring the metal. I mean, metal has been leased for years and years, and I think some of the entities that lease metal are saying, we want our metal back.
Everything we've laid out points to one inescapable conclusion. $500 silver isn't a fantasy. It's the logical endgame of a broken financial system colliding with a hard limit on real-world supply. When the paper facade crumbles and the scramble for physical begins, silver won't climb in a straight line. It'll detonate. Because silver isn't just another commodity. It's money. It's energy. It's trust, in a world where trust is evaporating by the day. As Comex vaults run dry, as derivatives unwind, as global confidence collapses, silver becomes the final exit door. And when the masses realize that the door is only big enough for a few, the stampede begins. What we're witnessing now is the calm before that rush. Smart money is already positioning. Sovereign wealth is already shifting. The mainstream just hasn't caught on yet. But when it does, everything changes. If you're watching this, ask yourself, are you prepared for what comes next? Because history doesn't wait for headlines. It punishes the unprepared and rewards those who can see through the fog. Subscribe now to stay ahead of the financial reset and stay informed as silver takes center stage in the most important monetary shift of our lifetime. This is not financial advice. Please speak to a licensed professional before making any investment decisions.